UK pensions are in a crisis. Many have either not saved enough to have a reasonable quality of life in retirement, and many have no idea what their income will be. The UK government has come up with some sweeping reforms for UK pensions, including greater investment in private equity. But do these reforms address the problems, or will they make things worse? Today's video is sponsored by Trading212, a UK commission-free investment platform. Let's begin by looking at the scale of the crisis in pensions. And a good place to start is with the Pensions and Lifetime Savings Association estimates of reasonable incomes in retirement, both for a single person and for a couple. You'll see this is graded into three tiers. The lowest is a minimum income, then we have a moderate income and a comfortable income. Now, of course, everyone's different and we'll all have different expectations of what's comfortable and what's the minimum income, but what's great about these numbers is that they're a good starting point. Now, there was a large survey done by Standard Life where they asked over 16,000 people about their retirement, and they asked two questions. The first question essentially was, what retirement income do you expect? And the second question was whether this post-retirement income was a downgrade from their pre-retirement income. Now, importantly, they also allowed categories for don't know for both of those questions. And as we'll see, that was quite a popular option for many people. So in this flow diagram, what you can see are the responses to those questions, and you can see the percentage of people which fall into each of the categories. Now, most disturbing of all, I think, are the 20% of people that simply didn't know or couldn't guess what their retirement income would be. If anything, I think that's a conservative estimate. If I were to walk down the street outside my house and ask people, I'm guessing that most people wouldn't know what their retirement income would be. And if we were to scale that up for the entire country, that's 6 million people who simply don't know what their retirement will be like. Then a further 15% of people expected an income which was less than the PLSA minimum income. And I think it's fair to call that category financially struggling. That minimum income was pretty basic, and it's quite shocking that so many people will not reach that level. Then we've got the undersavers, who are people who think they'll have enough, but when you actually do the sums, it turns out they probably won't have enough. So you could describe this category as people who've got uncalibrated expectations. Then we've got the downgraders, who are people who will have to take a step down in quality of life after they retire because their post-retirement income will be significantly less than their pre-retirement income. And then only 14% of the people made it through to the bottom box, which is the happy place to be, where people are happy with the amount they'll be receiving in retirement and they've got a fairly good chance of getting there. Now, the reason why I think this is a crisis is firstly that there's not good education about investment and about retirement in the UK, so people have no idea what they're going to have in retirement, and they simply haven't got the tools to know how much they'll have in retirement. And one consequence of that is that many people think they'll have a comfortable retirement, but in fact won't because they haven't saved enough. And then finally, many people will find themselves in retirement, but will have to take a considerable step down in quality of life when they retire. Now, it doesn't have to be like this. I think if financial education was better in the UK, if it was the case that we had the tools to work out how much we'd have in retirement, to work out how much we have to save to get there, all of that could be addressed. So that is why I think we've got a pension crisis in the UK. Now, before we look at the government response to the crisis and also the potential problems that come with that response, I'd like to talk about Trading212's ISA. And today's video is sponsored by Trading212. Now, I've been using their stocks and shares ISA for a few years, and I love the platform. Here's why. Firstly, it charges no account fees or any monthly or annual subscription fees. Secondly, it offers lots of choice for my fund portfolio, which is what I run on their platform. They offer over 13,000 ETFs and stocks, and this is from the UK, US and Canada and Europe. And then finally, it's introducing new functionality all the time. For example, it offers fractional shares, it has pies and auto investment. And if I had to choose my favorite feature, it would definitely be pies. So you can create portfolios within your ISA. If I want to rebalance one of my pies, I can do it with just one click. And you can fund your pie using regular investing via direct debit. And that encourages a good habit, which is regular saving. You can also reinvest any dividends generated by your investments back into the pie automatically. If you are scratching your head trying to decide what to include in your pie, there are lots of popular portfolios and even portfolios created by professional fund managers. Furthermore, Trading 212 charges no account fees whatsoever on their stocks and shares ISA. Their ISAs are flexible, which means that within a tax year you can withdraw cash and put it back into the account without affecting your ISA allowance. Your money is kept in a segregated account and protected by the Financial Services Compensation Scheme up to a value of £85,000. Now, as a viewer of PensionCraft, you get a special offer from Trading 212 where you can claim free fractional shares worth up to £100. Just open an account, verify it, fund it, and use my name as the promo code, which is RAMIN, RAMIN, and you'll find a link to that offer in the description below. Now let's look at the government's response. I'd say the biggest change that Rachel Reeves is introducing is consolidation. So instead of lots of little pension funds, we're going to aggregate these pension funds together and produce mega funds. And to quote Rachel Reeves, she says these reforms mean better returns for workers and billions more invested in clean energy and high growth businesses. So I think the government sees this locked up capital in UK pensions as a piggy bank in order to stimulate UK growth. And the clear tension here is between, on the one hand, the best outcome for savers, and on the other hand, using that capital to stimulate economic growth. Now, ideally, both of those two aims would pull in the same direction: good returns for investors and good growth for the UK. However, given the structure of these plans, I think that might not be the case. And I can see why the government is so keen to unlock this capital as they describe it, because the amount of capital in UK pensions is considerable. Here you can see in 2023, the total was around £3 trillion. A lot of money is invested in now closed defined benefit schemes. These offer a defined level of income regardless of what happens to markets in retirement. Usually they're inflation linked, but those are largely a thing of the past. They're not open to new members. What most of us have nowadays are defined contribution pensions, where we take the investment risk, and if the money is invested poorly and it has poor returns, then we'll simply have less money in retirement. And another reason why the UK government's not too happy about the way this money is invested is that decreasing amounts over time have been invested in the UK markets. The UK bond market, the UK property market, and of course UK infrastructure. Now, the reason for the money to be moved elsewhere has been greater return. And I think this is one of the reasons why the aims of the government, which is to stimulate the UK economy by investing more in infrastructure, are at odds with the aims of these pensions, which is to get a good return. Fund managers have moved money out of the UK because, frankly, the returns have not been very good. They've had much better returns in, say, the US equity market and international equity markets. Now, one of the reforms which I think make a lot of sense are the consolidation plans. If you have pension mega funds, then you have greater economies of scale. You probably have trustees who are top-notch and very well educated about different types of investment. And instead of the current situation where you've got hundreds of schemes with fewer than 100 members, you just get these very large funds which have a lot of pricing power. So, for example, there's going to be a consolidation of local government pension schemes. 86 of them are going to be merged into 8 larger pools, creating some of the largest pension pots in the world. There's also going to be consolidation in the private sector, so defined contribution pension schemes, where they're multi-employer defined contribution schemes, where more than one company pool their capital into one fund. In order to participate in auto-enrollment, these are going to have a minimum size. And the number being bandied about for that minimum size is 25 billion. Now, currently there are 60 different multi-employer schemes, so I think that consolidation could make sense. And at the moment, we have a situation where we've got 10 schemes with more than 25 billion. By 2030, if these plans come to fruition, there should be 20 pension funds with more than that amount. The place where it starts to get problematic for me is when we get to the Mansion House Accord, which is how the money is invested. Now, the government secured voluntary commitments from 17 major pension providers in the UK to invest 10% of their default funds. Those are the ones you invest in if you don't opt out or choose which fund to invest in. For those funds, 10% of their investments will be in private assets, which we'll talk about in a second, and at least 5% is going to be invested in UK assets by 2030. So are private markets the answer? Well, you're probably thinking, Roman, what are private assets? Well, they come in many flavors, but really it's anything which you can invest in that isn't listed on a public exchange. So for example, it could be private equity, where you own some of a company, even though it's not listed on an exchange. Or it could be private credit, where you're just lending money to a company rather than buying a stake in that company. And you'd receive interest on that loan and hopefully get your money back if the company doesn't default. Now, the benefits of private investments are firstly that you get to invest in high growth companies. Often this is early stage funding of companies, and if those companies are successful, then your returns are potentially very high. Of course, the failure rates are also quite high. Or it could be mid-scale companies which are being scaled up to large-scale companies. So you can see how this could benefit UK growth by providing capital for companies to grow. They'll employ more people, increase wealth, and so on. Also, many companies are now staying private for longer before they list on the stock market. So in theory, at least, this should allow private investments to fish in a different pool of assets, or provide a wider opportunity set, as private investors often describe it. Furthermore, the volatility of these private investments often seems low because they're difficult to price. Whereas with a listed stock, you can observe its price minute to minute on the stock exchange. With a private investment, you very seldom know what it's actually worth until it's sold again. And then finally, if you want to diversify your portfolio, the correlation of these private investments to listed investments like stocks and bonds is often quite low. So it may provide diversification. So those were the benefits of private investments. Here are my concerns. The first one is liquidity risk. Now, liquidity is the ability to sell investments and rapidly turn them into cash. Now, you might be wondering why you'd want to do that as a pension fund. Why would you need cash in a hurry? Well, if there is a market dislocation, and we saw this with the trust quarting budget, then you may find yourself in a position where the pension fund has to sell assets rapidly. In this tweet from 2022, you can see someone who just got off the phone with an investor for a big UK defined benefit scheme, who told me they're throwing the kitchen sink to meet margin calls on their LDI strategy. That's liability driven investment. Bonds, equities, everything liquid is being sold. Now, that was an interest rate shock due to worries about the sustainability of UK debt, but more broadly, you can have any kind of shock creating these liquidity crises. And the sequence of events would be you get a market shock, asset values fall sharply. If the pension fund has any kind of derivatives, even if those are a hedge, you can get a margin call on those derivatives, which means the pension fund has to stump up cash. Or it could be that their investors are panicking and pulling out their money. Those are called redemptions. Either way, the pension fund has to sell assets to meet those redemptions or to meet the margin calls. What do they sell? They sell stuff that they can. Often that's stocks because they're easy to sell and quick to sell. It could be gilts, assuming that market's not in trouble. But if you've loaded up on private investments, those are notoriously illiquid. If it's an infrastructure project, for example, you can't sell bridges quickly. So a move towards private investments is making these pension funds less liquid. And that's a risk. Another problem is high fees. Private equity funds typically charge 1%, even 2% fees. And then there's also a performance fee if they perform well. I found a nice quote from a company called Stepstone, which said private equity fees are like snowflakes, abundant, unique, and lacking in transparency. So in this table from one of their research publications, you can see the various fees which are charged by private equity funds. Not only do you have management fees, but you'll also end up paying for things like director fees, monitoring fees, auditing and tax expenses, fund administration expenses, and then of course if they do deals, which is their purpose for existence, then you'll also have fees associated with those deals, legal fees and so on. So often that adds up to 1% or 2% or even more, depending on performance, and of course that's going to be a drag on return, and that's not good for investors. If you manage your own pension, you'll probably know that you can manage it for 0.15% or less in total for everything. Now that's not a problem paying high fees as long as you get good performance. And the way private equity reports performance is in the form of something called an internal rate of return, or IRR. And here's a great quote from Professor of Financial Economics, Ludovic Philippou, and he says, early cash flows dominate the calculation, while later ones have almost no impact. You can invest for 40 years, make or lose billions, and your since inception IRR will still reflect that nice exit which you made in 1980. And being Alphaville, they came up with this nice meme which contrasts internal rate of return, which is what private equity funds publish and tout, and the actual returns which you receive as an investor. Now you can try this out for yourself in a spreadsheet. Just use the XIRR function. The first year have a really high return, say 100%, and then every year after that, 0. And you'll see the IRR is stuck at the very high return you got initially. It never forgets it. Furthermore, there's a 2 or 3 percentage point bias based on the typical return profile that these private equity funds generate. So if you imagine a private equity fund, if it has a very successful deal, it often goes through very quickly. So what you actually find is that when there's a very short maturity project, the payoffs tend to be very high. That's not always true, but it's often true. But as the maturity of the deals increases, you gradually get this tailing off of return, because those will be the less successful deals. It turns out that this maturity profile, combined with the way return is calculated with IRR, results in a fairly chunky bias of 2 or 3 percentage points higher in return than you'd actually receive as an investor. It depends on the type of fund. It varies between private equity funds, buyout funds, venture capital funds, but the bias is there for almost all funds. So in conclusion then, I think many of these reforms are positive. For example, consolidation of pensions into larger funds, I think that makes a lot of sense. However, forcing UK pension funds to invest in UK assets, which historically have underperformed, is not in the interests of investors and savers. Secondly, forcing pension funds to put money into private investments is not a positive thing. We've seen how there's an upward bias in the way the returns of these funds are reported, whereas the realized returns are simply not as high. Plus, there's a liquidity risk which pension funds probably don't want to increase in this environment. So while it certainly will add to the coffers of private equity funds, their fees will certainly benefit from having all this money flood in. However, I don't think that's going to necessarily be in the interests of UK pensioners. Now don't forget our offer from Trading 212. If you want to claim free fractional shares worth up to £100, just open an account, verify it, fund it, and then use my name as the promo code, RAMIN, RAMIN, and you'll also find a link to that in the description below. And, as always, thank you for listening.